In trading, the name of the game is to survive. The longer you stay in the game, the more chances you'll have to become successful. Contrary to belief, it doesn't matter what strategy you trade, but one thing's for certain is that you need a solid risk management plan in order to become successful. Having a well-defined risk management plan will help us stay in the game in the long run. So in today's video, I'm going to share with you my 5-step risk management plan and how you can use it to implement into your own trading strategy to save money. If you want to get the most value out of this video, make sure to watch the video till the end and make sure to take notes. With that being said, let's get started. So, in order to become successful in trading, what do we need to do? We need to start treating trading like a business. You hear this term getting thrown around all the time, but let's go into depth in exactly how you can start treating your trading like a business. The main thing in this case is to start thinking like a professional and not a gambler. Too many people come into the markets with a get-rich-quick mindset, and that is not going to be sustainable in the long term. In order to become a professional trader, what we need is a solid risk management plan that we can use consistently over and over again, that we can implement into our trading systems in order to execute every single day. Too many people come into the markets, they have no system, they have no risk management plan, and they expect to make money. You can make money by gambling, but that's not going to be sustainable in the long term. If we want to think like professionals and we want to trade for the long term, we have to start managing risk like a professional and not a gambler that's going to look to full port every single trade. So with this being said, what is the single most important part of trading? And that is managing risk. You'll hear me say this all the time, right? Managing risk is the single most important part of your trading. It does not matter what strategy you trade. You can be trading ICT, SMC, support and resistance, supply and demand. It doesn't matter what strategy you trade, but in order to become successful, everyone needs to have a solid risk management plan. And you need to become a professional at managing your risk. You need to become a professional money manager. And that brings me to the video. So how are we going to do this? So this is my 5-step risk management plan. It starts off with trading capital. How much capital should you be trading with, right? That is the great question that everyone always asks me. Next one is risk per trade. Once we understand how much trading capital we should be trading with, we then want to ask ourselves how much money should we allocate per trade. This is very important and I'm going to be touching up on that today. The next one is talking about risk to reward ratios. And then 4th is talking about win rate. And then 5, of course, is your maximum drawdown. So with this being said, let's get started. So how much money should you trade with? This is the magic question that everyone always asks me, Jack, how much money should I trade with? And the answer stays the exact same every single time. And that is simply money that you can afford to lose. I always condone that you need to trade with money that you can afford to lose. There's no worse feeling in the world when you're trading with money that you can't afford to lose, right? If you have bills to pay, if you have a family that you need to support, right? You need to take care of bills. You need to put food on the table. There is no reason you should be trading with that type of money. You need to trade with the money that you can afford to lose. This should be a portion of your income, right? You should have a stable job or you should have a lump sum of money that you're willing to lose in the markets. When you come into the markets, expect to lose money. I tell everyone the same thing, right? Trade with as least amount of money as possible. There's no reason to be allocating an insane amount of money at the beginning, especially if you're a beginner, because you need to pay market tuition. Me personally, however much money I can afford to lose is going to differ for you. Every single person has different financial circumstances. I have a different risk tolerance than you. You might have a different risk tolerance than me, but everyone should only be trading with money that they can afford to lose. That could be $1,000. That could be $10,000. That could be $100,000. But just know that trade with money you can afford to lose and never expect to make money when it comes to the markets, right? Always expect to lose money before you make money. So next thing I want to touch up on is risk per trade. The rule of thumb is that you should not be risking more than 1% of your total account size. This is very important when it comes to trading. There's no reason why you should be over leveraging, especially when you're trading options or futures. You should only be risking less than 1% of your account. If you want to go a little bit more aggressive, you can do 1 to 2%, but no more than 2% I would ever tell anyone, especially if you're a beginner. So for example here, right, you can see we have a 25K account. So if we have a $25,000 account and it's 1%, the 1% equals $250, right? So your $250 should be your max risk per trade. And of course, 250 is your 1R multiple. I'm going to be talking about R multiple here in a second. Your 1R multiple is your max risk per trade. So every single trade that you take, you should not be risking more than $250 or 1% of your total trading account size. Another example I have is for a $100,000 account. As you can see right here, $100,000 times 1% equals $1,000. So $1,000 is going to be your 1R multiple, and your 1R multiple is going to be your max risk per trade. So you should not be risking more than $1,000 per trade if you have a $100,000 account. Obviously, this is different for everyone, but this is just a good rule of thumb. If you're starting out, right, do not risk more than 1% of your total account size, especially if you are a beginner trader. So the next thing I want to mention is having a clear, defined stop loss. I see too many traders come into the markets and they do not have a clear, defined stop loss. Especially if you're a beginner trader, you might not think a stop loss is necessary. And let me tell you right now, if you want to become successful in the long term, you need to have a clear, defined stop loss. That could be a hard stop, that could be a mental stop, but it doesn't matter what it is, right? You need to have an idea of how much you're going to risk per trade. So for example, let's say we have a trade right here and we're making clear higher highs, higher lows, higher highs, higher lows, right? If you are looking to buy off this retest level, right, you're looking to buy in this area. What do we need, right? If we're buying in this area and we're looking to target here, right, what do we need? We need to have a clear, defined stop loss. This is going to be our break of structure level, right? Break below this key pivot low. So let's say this is 3 points, right? So let's say this is 3 points. We're looking for 3 points as well, right? In this case, 3 points is our maximum that we're going to lose, or 3 points is going to equal our 1R. So our 1R, we're risking 3 points in this case to make 3 points, and this is going to be our risk to reward ratio. We need to have a clear, defined stop on every single given trade that we take, right? We need to know our risk. We need to know how much we're making, which is 3 points. We need to know how much we're risking, which is 3 points as well, which equals to 1R. So this is a 1 risk to reward ratio trade. It doesn't matter what type of trade you have, but you need to have a solid risk management plan. So now we've gone through trading capital. We've also gone through risk per trade. Now it's time to talk about risk to reward and win rate. So on the left-hand side, what we have is two traders. We have trader A on the left-hand side and we have trader B. Trader A has a 25K account and they're risking 1R to make 1R per trade. So they have a 1-to-1 R multiple and they have a 75% win rate, whereas trader B is risking 1R to make 2R per trade, but has a 50% win rate. Based off these two statistics right here, and looking at the win rate, you would assume that trader A is making more money than trader B, because trader B is only winning 50% of the time, whereas trader A is winning 75% of the time. So both traders take 10 trades each. Trader A wins 75% of the time, which means they have 7.5 wins and 2.5 losses, whereas trader B wins 50% of the time, means they win half the time. So they win 5 times and they lose 5 times, right? So if you were just looking at both these two traders, you would assume that trader A makes a lot more money than trader B. But as you can see in this case, this is not the reality. Right, trader A with the 25K account, right, they're risking 1R to make 1R per trade. They have a 75% win rate. Their profit is going to be $7,500, assuming that in both cases, right, they're risking $1,000 per trade. So they're risking $1,000 per trade. They're making 1 R per trade. So 75% win rate over a 10 trade period is going to net you $7,500, and then you're going to lose $2,500 for an ending balance of $30,000. Whereas trader B, right, they're risking 1 R, they're risking $1,000 to make $2,000, and they have a 50% win rate. So they actually end up making over $10,000 because they have a 2R multiple per trade. And of course, right, when they lose $5,000 because they're risking 1 R per trade. So when they win twice as amount as they lose, and they have a 50% win rate. As you can see right here, they also have a $30,000 ending balance. So you can see in both these cases, right, they have two different win rates, right? Trader A has a 75% win rate, whereas Trader B has a 50% win rate, but they end up making the same amount of money. And why is this the case? The reason being is that having a higher win rate does not mean you're going to become successful. You see people all the time, they have these super high win rate strategies. They have 80, 90%, and that's what they advertise, right? They advertise those super high win rates and that you need a super high win rate in order to become successful. But as you just saw, I just proved that that's not the case. You can make money with even a lower win rate than 50% and still be profitable in the stock market. And the reason being is you need to understand the risk to reward. Whenever you're trading, you have to understand the risk to reward when you're taking trades. So in this case, as we can see, right, we're risking 1 R, right? So right here, you can see that we have a 1-to-1 R multiple. This means that we're risking 1 R to make 1 R. So that means, for example, right, we're risking $50, right? We're risking $50 to make $50. Right? If we have a 1-to-2 risk to reward ratio, what does this mean? This means we're risking the same R multiple. That means we're risking $50, but in this case, what is our reward? Our reward is 2R. So this is $100 worth of gains, right? And of course, right, your risk to reward on the third option is going to be a 1-to-3. So in this case, right, our R multiple stays the same. So we're risking $50, but our reward increases, right? It's our risk to reward. So our risk stays the same, but our reward changes. So in this case, right, what we would be looking for is $150 to make $50. It might seem obvious in this case, why would you not want to risk $50 to make more money? But of course, that comes with different problems. The lower risk to reward that you have, the higher win rate you're going to have. The larger the risk to reward that you have, the lower win rate that you're going to have. And that's what I'm going to be talking about in this next slide. So this next slide talks about everything you need to know about risk to reward versus win rate when it comes to trading. As you can see here, right, we have the not profitable line. So if you have a win rate and your risk to reward is in the red, that means you're not profitable. If you're in the yellow, that means you're break even. And of course, you're green, that means you're a profitable trader. So as you can see in this case, right, if you have a 30% win rate, but you have a 1-to-3 risk to reward ratio, that means you're a profitable trader. Right? You can have a 30% win rate and become a profitable trader as long as you're risking 1 to make 3. Right? You're risking $100 to make $300. And this is where I am. So I'm in this category right here, right? 50% win rate, around a 1-to-2 risk to reward ratio. That means I win around 50% of the time, but when I win twice as much as I lose. So this makes me a very profitable trader. You can have a 40% win rate and have a 1-to-2 risk to reward ratio and still be very profitable. As long as you're on this green, right? Obviously you want to be as close far right to as possible, but that's just unlikely to have a 90% win rate and a 1-to-9 risk to reward ratio. Majority of traders are going to be around that 40% win rate mark with around a 1-to-2 risk to reward ratio. Some traders have a higher win rate, but what comes with higher win rate is lower risk to reward ratio. And if you have a lower win rate, you need a higher risk to reward ratio. This is just the bare bones of trading. Don't let anyone tell you that you can't be profitable if you don't have over a 50% win rate. Majority of my time, right, I'm going to have around a lower than 50% win rate, but what makes up for that risk reward ratio is those A+ setups. When I have those A+ setups, that just boosts my risk reward ratio up, and that makes me very, very profitable. Just those 1 to 2 A+ setups a month that I always talk about. So if you ever see someone flashing their win rate, just understand that they have a lower MAR multiple, and if they have a higher R multiple, just understand that they have a lower win rate. It goes hand to hand. You can't have a high R multiple with a high win rate, and you can't have a low R multiple with a low win rate, right? You have to find that balance that works for you. The last slide that I have is maximum drawdown. The max amount of money that you're willing to lose at any given time. This is very important. I feel like a lot of people don't talk about this, is that you have to have a max drawdown, and you have to have an idea or a set rule in place in case you end up revenge trading or you lose control. This can be manual. This can also be a mental maximum drawdown. I prefer having a broker come in and having a set maximum drawdown, right? Of course, this can be a daily maximum drawdown, a weekly maximum drawdown, or a total account size max drawdown, right? This is basically calculated after figuring everything else that we talked about in this slide. So for example, if you have a 25K account, a good rule of thumb is a 10% maximum drawdown. So if you have a 10% maximum drawdown, this equals $2,500. This can be on a potential given day. This can be a weekly maximum drawdown or a total account size drawdown. So if we talk about this, for example, right? If we have a $25,000 account with a 10% drawdown, right? This equals $2,500, right? $2,500, right? So if we understand on any given day, we can't lose more than $2,500, and let's say each risk per trade equals $500, right? That means we can take a maximum trades of 5 trades, right? We can take a maximum of 5 trades to get to our max drawdown. So if we lose 5 trades in a row, that means we have to stop trading. If we're risking $500 per trade, 5 trades equals $2,500. That will be our maximum drawdown. So we can only have 5 trades at $500 loss per trade. So that means on any given day, we can only risk $2,500. So if we lose 5 trades in a row at $500 a piece, that means we have to cut it for the day, and we have to get off the screens and make sure you have a mental reset as well. So that is it for the video. And understanding risk management is so important when it comes to trading. Having the framework of understanding how much capital you should trade, how much risk per trade that you should allocate, right? What's your risk reward? What's your win rate? And having a maximum drawdown is all essential to having a solid risk management plan. I hope you guys enjoyed that video. If you did,